What if the company the world declared disrupted by AI is actually the one building the AI infrastructure everyone else depends on and still controls 90% of global search? Welcome back. Today we're going through Alphabet top to bottom, the business, the financials, the moat, and where things could go right or wrong from here. We'll cover all 4 of its major revenue engines, look at what the free cash flow picture actually tells you, and walk through both the bull and bear cases with as much honesty as the numbers allow. There's a lot of noise around this stock right now, so the goal is just to cut through it and figure out what we're actually dealing with. As always, nothing in this video is financial advice. Do your own research and make decisions that fit your own situation. Alright, let's start with the business itself. So the narrative around Google for the past couple years has been that AI was going to eat their lunch. That ChatGPT would poach search users, that the ads business would crumble, that Alphabet was yesterday's tech. And yet here we are. The company's market cap has moved from roughly $2.1 trillion to $3.31 trillion during that exact same period of supposed existential threat. That's not a stock that's losing. What we're actually looking at is a company running 4 distinct, large-scale businesses under one roof. Search and advertising, cloud infrastructure, YouTube, and a portfolio of early-stage bets that don't show up in the earnings multiple at all. The rest of this breakdown is about whether the market has finally priced that correctly or whether there's still a story to tell. Building on that 4-engine idea, it's worth spending a minute on what each of those actually looks like at scale, because the conglomerate structure is unusual. Google Search and Advertising is the core. It processes billions of queries daily and monetizes through one of the largest ad networks ever built. Google Cloud is the infrastructure business, selling compute, storage, and increasingly AI services to enterprises worldwide. YouTube sits somewhere between media and tech. It's both an ad platform and a subscription service at this point. And then there's Other Bets, which is a catch-all for things like Waymo's robotaxi operation and Wing's drone delivery work. What makes Alphabet interesting structurally is that these 4 segments have very different growth rates and margin profiles, and the stock price has historically reflected only the most visible one. Total revenue across all of it crossed $400 billion in fiscal 2025, up 18% from the prior year. We'll get into the specific numbers on the next slide. So those 4 engines combined to produce some numbers that are worth sitting with for a moment. $402.8 billion in annual revenue growing at 18% on a base that size. That kind of growth rate is unusual. For context, 18% of $400 billion is $72 billion in new revenue in a single year. There are entire S&P 500 companies smaller than that increment. Net income came in at $132.2 billion, and the net margin of 32.8% means roughly a third of every dollar of revenue drops to the bottom line. Gross margin is running just under 60%, which reflects the high software, high services mix across the business. EPS landed at $10.80 against a forward PE in the mid-20s. The one number that doesn't fit the pattern, and we'll get to this right after, is free cash flow, which came in dramatically lower than that net income figure would suggest. And here's the tension that sits at the center of any serious Alphabet analysis right now. Those margin figures from the previous slide are exceptional, but free cash flow came in at $38.1 billion, a 9.5% margin against a net income line that's more than 3 times that size. The gap between the two is almost entirely explained by capital expenditure. Alphabet guided $175 to $185 billion in Capex for 2026, which is an unprecedented level of investment for any company in history. That's not necessarily bad. It's a deliberate bet on AI infrastructure. But it means the cash flow you'd normally use to evaluate a business isn't the number to anchor on right now. The free cash flow / net income gap is the single most important metric to track as this investment cycle plays out. Because when and whether it closes determines whether this is a great business or just a complex one. So after all those headlines about AI killing search, let's look at what the data actually says. Google holds roughly 90% of global search share as of early 2026, processing over 16 billion queries every single day. Perplexity, the AI native challenger that's gotten the most press, is sitting below 2% share. That's not a disruption story, that's a rounding error. And the really interesting wrinkle is what happens when users actually engage with AI overviews and search results. They bounce less, spend more time on the destination site, and view more pages per visit. That's improving advertiser ROI, not destroying it. The disruption thesis was always cleaner in headlines than in the underlying behavioral data. If search is the defensive moat, cloud is where the offense is being run. GCP grew 48% year over year in Q4 2025, outpacing Azure's 39%, and is now sitting on a $240 billion backlog that grew 55% quarter over quarter. That backlog figure is important because it tells you demand is being booked faster than it can be fulfilled. Operating margins in the cloud segment have settled into the 29 to 31% range, which means this is now a genuine profit engine, not just a growth story being subsidized by search. And underneath all of it is the silicon advantage. TPU v7, codenamed Ironwood, delivers 10 times the peak performance of its predecessor and creates roughly a 30% total cost of ownership advantage over running equivalent workloads on NVIDIA GPU clusters. The massive Capex cycle we covered earlier is largely building out this infrastructure. It's not just spending, it's constructing a cost moat that compounds. The advertising business is worth a closer look because it's more defensible than the headline numbers suggest. Performance. Max, Google's AI-driven campaign format, now accounts for roughly 45% of all Google Ads conversions globally, and over 70% of advertisers are using it. When a tool handles nearly half of your conversions, switching becomes difficult regardless of what a competitor offers. YouTube adds another dimension. It now commands about 12.5% of total US TV viewing time according to Nielsen, and connected TV ad revenue is on track to cross $9 billion in 2026 as dollars continue moving away from linear. Shorts hit 2 billion monthly active users and recently achieved revenue per watch hour parity with long-form content in key markets. That's the metric that matters for monetization, not just engagement counts. So the ads business isn't just search, it's a multi-surface lock-in across the attention economy. Pull back and look at where Gemini is right now and it's a different picture than the Google is losing AI take. 750 million monthly active users and over 8 million paid enterprise seats growing at roughly 3 times the rate of ChatGPT+. The enterprise penetration is what matters for the long-run revenue model. Consumer free tiers are scale, but enterprise subscriptions are margin. GCP's $240 billion backlog, which we touched on 2 slides ago, is partly a Gemini infrastructure story, companies booking cloud capacity specifically to run AI workloads. The Samsung Galaxy S26 adoption is a subtle but telling signal. When Android OEMs start displacing their own AI layers with Gemini Nano, Alphabet starts becoming infrastructure at the device level, not just in the cloud. That's a different category of moat than advertising lock-in. Taken together, search dominance, cloud backlog, custom silicon, and early enterprise AI traction aren't 4 separate stories. They're one compounding advantage. Beyond the core businesses, Alphabet carries 2 embedded options that don't show up anywhere in that 25 times earnings multiple we covered earlier. Waymo is completing 500,000 paid robotaxi rides every week right now, not in testing, not in simulation, in commercial operation, and it's targeting double that by end of 2026. Private market investors have valued it around $100 billion on a standalone basis. Wing is targeting drone delivery in a market projected to grow at over 40% annually. Neither of these shows up in the consolidated PE. When the market prices Alphabet as a search company with a cloud business attached, it's implicitly assigning close to 0 value to both. Whether they ever fully materialize is uncertain, but they're not 0. And that asymmetry is worth keeping in mind as the core multiples compress. Now for the other side of the ledger. That Capex commitment, the number that's driving the gap between net income and free cash flow, is the central bear case risk. If AI monetization takes longer than expected, Alphabet will have committed an unprecedented amount of capital against revenue that hasn't arrived yet. That's not a hypothetical. The free cash flow margin we covered earlier is already reflecting that pressure. Then there's the regulatory dimension. The DOJ antitrust cases targeting search distribution agreements and the ad tech stack aren't resolved. And they go after exactly the revenue that funds everything else, the highest margin lines in the business. Management has essentially no control over timing or outcome there. And performance. Max, despite driving nearly half of all Google Ads conversions, is a black box system advertisers can't fully audit. That opacity is a lock-in mechanism. But it also creates real backlash risk if budget allocation becomes a transparency issue. This one is worth being direct about. A 57% move in market cap changes the conversation. When the prior thesis identified 40 to 50% upside from $2.1 trillion, that math worked because the stock was trading well inside the sum of parts range. That gap has now largely closed. Alphabet's market cap sits at or above what the prior intrinsic value ceiling implied, which means buyers today aren't getting the same setup. This is still a high-quality business with durable competitive advantages. But at 25 times forward earnings, there's less cushion for a GCP growth deceleration, an ad market softening, or a Capex ROI that takes longer to show up than expected. The thesis hasn't changed direction. It's just that execution now has to keep coming through quarter after quarter with less margin for error built into the starting price. So what actually moves this stock from here? There are 4 specific things worth tracking. First, Whether GCP sustains the growth rate we discussed and crosses $70 billion annualized, that's the number that starts justifying a standalone cloud multiple. Second, Waymo hitting 1 million weekly rides, which would be the catalyst for the market to finally start pricing that asset separately. Third, free cash flow normalization. As the Capex cycle peaks and depreciation starts replacing new spend, the gap between that net income figure and free cash flow should start closing. And that convergence is where the earnings quality story improves materially. And fourth, Gemini enterprise seats scaling well past 8 million across the workspace base, which is where AI monetization goes from interesting to structural. On top of all of that, the $70 billion share repurchase program is quietly compounding per share value regardless of which of those four catalysts lands first. So zoom out to 2027 and the story changes character. Right now, Alphabet is in the spending phase. The Capex cycle we've been tracking is consuming cash that would otherwise flow to shareholders. But infrastructure spending doesn't go on forever. At some point, depreciation on existing assets replaces the need for new outlays. And when that happens, the gap between that net income figure and free cash flow starts closing. If cloud sustains strong growth at the margins we've seen and Gemini enterprise seats keep scaling, you could plausibly arrive at $80 to $120 billion in annual free cash flow. That would put Alphabet in a category occupied by almost no other company in history. The key variable isn't whether it happens, it's timing. Every quarter, the backlog grows and TPU infrastructure matures. That 2027 Harvest Thesis becomes a little more concrete. After all of that, the revenue scale, the cloud inflection, the silicon edge, the embedded optionality in Waymo, the free cash flow trajectory, the verdict is pretty clear. The bull case is executing. GCP is growing fast and profitably. Gemini is scaling enterprise seats. Search hasn't cracked. What's changed is the price you pay to own it. At $2.1 trillion, this was a misunderstood conglomerate with a wide margin of safety. At $3.31 trillion, it's a quality compounder that needs to keep delivering. That's a different kind of investment. The upside is real, but it's earned quarter by quarter now, not sitting there waiting to be unlocked. If the Capex cycle normalizes on the timeline we outlined, and GCP keeps its growth rate, there's still a path to a materially higher valuation. But it takes execution, sustained, consistent, boring execution, and entry price no longer gives you much forgiveness if a quarter goes sideways. That's the full Alphabet breakdown. A company this size with this much going on is never a simple story. There are real questions around capital allocation, regulatory pressure, and whether the market's willing to keep rewarding it the way it has. But the underlying business is hard to dismiss. Anyway, I'd love to know what you think. Are you still constructive on Alphabet, or do the risks outweigh it for you at current prices? Drop it in the comments. If you found this useful, subscribe so you don't miss the next one. Thanks for watching.